Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Tuesday market webcast. Okay, daily chart, and we talked yesterday about they gap it down. Here, the green line is your daily mid-band. And one of the basic tenets that I've used for as long as I can remember is that the daily mid-band is the delineator about basically the general philosophy of the tape. Whether you're talking about the mini, really a stock, anything out there, really. An issue that wants to trade between the upper band and the middle band is generally a buy dips tape. I don't think there's really any argument that we've been buying dips for as long as, pretty much as long as we can see on this chart. Conversely, when the daily mid-band gets converted, something that wants to live between the middle band and the lower band tends to be a sell rallies market. And that's what we are transitioning into now, unless the bulls can get it back up over the daily mid-band, reconvert it, and turn it back into support. So you can see it was essentially the high yesterday. After the gap down, we opened at 69.75 Sunday night. That was your high. Traded as low as 33 off of the regular open yesterday. Globex last night. You got a high in here at 63.75. So it's a lower high relative to the prior day. Didn't challenge the daily mid band. The task the bears have in front of them today is to take out that 33. If you're going to put in lower highs, you need to put in lower lows. And that opens up a move down to the lower band in and around 32.07. So the bigger picture on the daily chart on the S&P Futures has always been upper band, middle band, lower band, middle band, upper band, so on and so forth as we head. In an environment that we've really seen since September, where it's really been a one-sided tape. Our last interaction with the lower band was back on October the 10th, and it's never even, it had a little bit of an approach here, December the 3rd, which was the last close below the daily mid-band before yesterday. But generally, over 90% of the time, we have been trading above that daily mid-band, and that has been it's been a buy dips tape. It's been a great tape to be long. It's been a great tape to just ride that upside and let everybody else hate it, and it's done very well for us. If we're going to be changing the character of this market, then the last 36 hours, 48 hours of tape and the next 48 hours of tape are going to be really important. And you could even say all the way into the first week of February. I've always said about January's, the first half of the month tends to go the way the prior year went. Everybody thinks there's going to be a sudden change just because it's magically January. That tends to not be true. But usually mid-month to later month, if there's going to be a pullback, that's when it tends to come. The onus now is on the bears to see how much they can get out of this. And it's all about what they do during the course of these rallies. There will be violent pops in any down tape. There always are. How do you react? So, in the bigger picture, we opened up 9:30 yesterday morning Eastern, 33. We've traded as high as 62 and change. What are we going to do now? We're back down. Traded as low as 41.75 about 30 minutes ago. They need to break 33 today. If they do that, then they're asserting themselves and saying, you know what, it's a sell rallies tape, and you will see the tape flow in that direction at least a little bit further. And then, as you get down into the lower band in the 50-day, it can make, that'll be the next decision point for this tape, in my opinion. So that's your bigger picture. On the hourly chart, You just have a whole lot of consolidation that broke to the downside gap, and it's kind of consolidating again. I mean, nothing dramatic happened yesterday in the way of price. It was a pretty choppy day, to be truthful. You can see the test here, 62 area. Early yesterday morning, 62.25 was resistance on the push down to 33. So 62.63 is big. If they do get back up into that gap, I don't think they really want to, but if they do go up and fill it there at 91, they better have a whole lot more in the tank than they have had in the tank at any of those moments in the last 5-6 months. You could argue all the way back to December of 18. The Bears better have more in the tank than they've ever had. Otherwise, we go right back up. So the best thing for the Bears is to hold it down here, break that 33, and try to reach a little bit further. As we head into the open today, you've got the hourly mid-band there right at 50. Volume weighted average price is at 51. Our proprietary moving average is at 49.66. Daily pivot comes in just under 48. So 48 to 51 is going to be a big deal off the open. That's your bull bear line. And as long as that area can hold, you can continue to be short. If they convert it, then in my opinion, if you're not already long, then you got to get out of the way, let the thing pop, see if it settles, and then try to sell that rally. If the selling of rallies stops working, then you're going to have to be flexible in your approach. You don't want to dig in. You never want to be an ideologue. Then you say to yourself, okay, well, you know what? If they're going to squeeze them, then I'm going to squeeze them too. And, you're flexible. You get long because if you're not going down, you're going up. And, off you go. But it's a very important day for the Bears. That 33 really needs to go. If they can do that, they'll really assert themselves and establish this as a sell rallies tape. All right. Everybody have a great day. More stuff out on social. Come check out the room. Trade them well. I'll talk to you tomorrow. Follow us over on Twitter, Instagram, and Snapchat at Princetontrader. Check us out on Facebook and join us for a free trial at www.princetontrader.com. Trade them well.